China is today's topic, specifically the Chinese equity market. Hey, everybody, Serge Berger here, back for another episode of the Steady Wealth Podcast. And I am excited and quite frankly honored to have the Chief Investment Officer of Crane Shares here. His name is Brendan Ahern. I just learned how to pronounce his last name properly. And you guys have probably dabbled or maybe even owned some of their ETFs, like the K-Web ETF, for example. Brendan is the Chief Investment Officer of this firm. And we want to talk a little bit about China. Is that rally we've seen here year to date, is it sustainable? Some of the aspects that are going into this analysis that go beyond a chart analysis, I think, or something that we are going to uncover here today. Brendan, great to have you here. How are you?
I'm doing great, Serge. Yeah, many thanks for the opportunity. It's great to connect.
It's wonderful to have you here. And what I'm going to do as well is I'm going to be sharing the screen for those people that are watching this on YouTube, because we are going to be referencing an article that Brendan penned a little while ago, basically his top 5 sort of analysis points. We're going to walk through those right now. But Brendan, give us a quick sort of summary here. In short, before we go a bit deeper, because the deeper part is very important, is China still investable in terms of this rally? What are you thinking here? Not for the next 2 weeks or so, but maybe a 6-month, 12-month sort of outlook. What are you thinking here?
Yeah, we definitely do. We think big picture U.S. equities have outperformed non-U.S. equities for 15 years, and that includes China and broader emerging markets. But at the same time, this underallocation really led to a derivative-induced meltdown in Chinese equities in January. And we think that obviously we have this liquidation event, you have this rally taking place. And we just think there's several things that are happening behind the scenes that China's been off people's radar and things have picked up there. And we just think there's several catalysts that could actually keep this rally going over the next several months, simply because of this underallocation, as well as some of these positive developments that, again, aren't getting a lot of attention from Western media, but to definitively have occurred.
Yeah, and so I think just quickly for everyone's reference points, what Brendan's talking about, the sell-off, if you will, I'm just looking at the HSI here as a reference point to China. Basically, after the highs in 2018, the HSI fell about 55%. That's what you are referencing there. And we've had a nice rally now. I think the rally since earlier this year, HSI was up as much as 30-ish%, given back a little bit here at the very near term. Not that relevant. One of the things that I keep hearing when I talk to clients, both on the newsletter side, but also on our investment advisor side, people are skeptical. This is largely a headline-driven skepticism. Can't trust the government, China, et cetera, et cetera. But then you talk to other people that are just more opportunistically tuned, looking at the world. Okay, is this an opportunity regardless of my political views or not? And this is not about politics, our show here at all. That's one of the sort of humps to get over. So when you talk to clients, like what are some of the opposition points? And then maybe we can start talking about some of those 5 points that you penned.
Yeah, certainly the geopolitical narrative is a big focus. And I think one of the things that it's key that the US and China get along, that these economies are highly intertwined with one another. Every investor in the US is implicitly invested in China. Just big US multinationals, if it's Apple, Boeing, Caterpillar, NVIDIA, Texas Instruments, Tesla, ExxonMobil, you have significant revenues taking place in China. So we all need the US and China diplomatically to get along, because US corporations are doing very well in China. That's part of what's driven a lot of the growth in US equities, is actually their success in China. It's just who had a better trip to China, Anthony Blinken or Elon Musk? I wish the diplomats from both sides would take a page from the China as well as the U.S. business communities, who are getting along just fine with one another.
Yeah, and that spills over into the media, which then leads people to not be able to be thinking about this opportunistically and more just, okay, this could be some sort of political problem for my portfolio. But let's just walk through the 5 points that you mentioned. One of the things that I have been talking to our clients about, for the most part, since I think about February, is there was a little period of about a month, and I would imagine it was I think it started maybe late January or second half of January into maybe March. I'm not exactly remembering like the exact timeframes, where literally almost by the day, there would be more headlines coming out of China. Every morning I would wake up and be like, okay, China is investing here. They're buying shares. They're doing this. And I know you mentioned some of these things. I don't know if that's continuing or where we are because I haven't seen those headlines in a while. But to me, that was a real eye opener that they're really basically backstopping everything. And to me, that money flow, especially coming from the government, is always something I want to be interested in.
Yeah, 100% that you listen, China shut down its own economy during zero COVID. That really hurt fundamentally a lot of the underlying companies. And that this underweight really led to this January meltdown. And the Chinese markets don't have circuit breakers like here in the
Yeah.
US. So the government entities, like their sovereign wealth fund, basically went in and started buying China ETFs in China, as well as mega cap stocks. And the reason they bought these mega cap stocks and these China ETFs that are focused on large caps and mega caps is they know that they can influence the stock market indices. They're not buying the stock market, they're trying to stabilize the market. So by buying these biggest names, it pulls the indices up. And so that is a very strong sign that the government is just saying enough is enough. But we're actually seeing investors in China, asset managers, institutions buying stocks in Hong Kong, that the Hong Kong Stock Exchange actually tracks these flows out of China into Hong Kong stocks. And year to date, they've bought about $35 billion of Hong Kong stocks net of sales. And that's versus 40 billion in all of 2023. So the government itself is saying, and institutional investors in China are saying, this is a great opportunity for long-term investors to buy Hong Kong stocks, and they're putting their money where their mouth is.
Yep. And what's interesting as well that you're mentioning, Brandon, and I know we quickly touched on this off camera, maybe something for another time, a bit more detail, but just as a side note, what you're mentioning here and you wrote in your piece is that these government entities or related government entities, they are buying not just stocks, but they're actually buying the ETF. So I'm saying this because I think a lot of people on the retail side have not yet understood how important ETFs are for the whole market structure. So I think that's an important point. So the government's buying stuff. They've also, I think, added all sorts of incentive programs, if I saw to some extent. What about from an investor base? Just going to your point too, you penned, I think, very nicely in terms of the exodus out of Chinese stocks in a couple years ago at this point, US led, then Europe, and so on and so forth. And now you're thinking that's reversing, domestic Chinese investors coming back in, and ultimately international. What are you seeing there? Are you seeing that trend to potentially continue, or is that a flattening out story as we go deeper into 2024?
Yeah, certainly this unwind in China from a geographic perspective, we're seeing it rewind in reverse. So you have investors in China are buying Chinese stocks. As we mentioned this, we're also starting to see within Asia, a lot of money in Asia that historically was in China. And because of zero COVID and geopolitical, it went into Japan and India. And you're starting to see some profit taking, some money coming out of India because of very high valuations. On Japan, there's a lot of concerns about the yen weakening. And I think some of that is showing up in flows that investors in Asia, where China is very important regionally from an economic perspective, just geographically, it's not going anywhere. China now does more trade in Asia than with the United States or Europe. And so those investors are very attuned to what's happening in China, and they're starting to come back in. So I think so you're seeing this unwind, and then the rewind is actually happening right now from investors in broader Asia reallocating in cheap Chinese stocks.
And that's not just like a thing that lasts for like a trade. I think that might be something worth emphasizing here. That's not something that stops in a week or two and lasts a couple of weeks. Like that could really be a trend that could last a bit longer, whatever that is, months and quarters at least kind of time frame would be my thinking. That's more of an aircraft carrier rather than a jet ski in terms of its maneuverability.
Yeah, this institutional
Right.
investors, they don't move on a dime. And it's not that they're giving up on India nor Japan. There's still great opportunities there. They're just simply saying, why wouldn't you take a piece of those profits and maybe move China from an underweight to a neutral weight? And in aggregate, we're talking about very significant dollars in motion.
Yeah. Yeah. No, that makes a lot of sense. And I think that's probably quite helpful for our audience. So again, it's the flows here, right? That's what I think when people just look at a chart or they watch the news and not go underneath the data, go into the data a bit more, it's very simple, easy to just say and remain skeptical. But I think if we go deeper, point three, you talk about this new policy support for shareholders. That too is probably something that I think a lot of people haven't thought through. Walk us through this a little bit, because I think that's something that, again, it's just coming from the state, right? Like from China, that can be very supportive of markets, of Chinese markets.
Yeah, and this is where you're part of what got Japan out of its doldrums, where you had this bear market going back from 1989 up until a few years ago, was the Bank of Japan went and basically bought every ETF in Japan. And then the Tokyo Stock Exchange said, if you don't get your price to book above one, we're actually going to publicly humiliate you. And China is doing a very similar thing. They're not buying China ETFs in China anywhere near to the extent of the BOJ, but they are buying. And then they're actually saying to companies that you should be paying dividends. You should be buying back stock. We're actually going to limit insider sales. We're going to slow down the pace of IPOs. Why? Because IPOs create more supply. And we're seeing that you can't help but notice in companies like Alibaba, Tencent, JD, Baidu, they're buying back stock in a very significant way. Alibaba paid its first dividend ever in the history of the company in December. This year, they're going to pay out $1.64. Tencent gave its ownership in JD.com and Meituan to shareholders. They're buying back stock every single day. Actually, it's interesting. In Hong Kong, when they buy back stock, they have to file every single day. In the US, you only have to file quarterly. So there's actually more transparency on Tencent, Meituan actually buying back stock. And that's leading to buyback yields where Alibaba is going to buy 5% of its shares outstanding this year. They bought 3% last year. So this buyback, they're becoming very shareholder friendly. And I think you'd say, that's common Western media narrative is China's about to go off a cliff. Well, companies would be hoarding cash, not buying back their own stock. And it's because they believe that the companies themselves are so inexpensive. And when meeting with companies like Tencent and Alibaba and BYD, they believe their stocks are undervalued and they're putting their money where their mouth is.
Another great point. And again, I think this is something that a lot of people are not really focusing on. Again, this goes way beyond your 50-day moving average analysis from the newsletter that people get. But I just want to quickly mention, so the KWeb ETF, and this is one of the ETFs that Crane Shares has, that you're the CEO over. It really, and this should not be surprising, it looks very closely, very much your Alibaba stock price and all the others. So there's a strong correlation. Do you expect that correlation to be consistent? And I'm not asking for, obviously, who knows how long a forecast, but is there something that could break the correlation within these Chinese internet stocks a little bit? I'm sure there's some, obviously, more smaller stuff, but for the most part, they're moving in tandem, like the US equity market moves for NVIDIA right now. Is there anything there that you're noticing?
Yeah, it's self-serving and highly biased. That we like the basket approach. That's, again, it's very self-serving, but
I do too, by the way. It's not supposed to be a trick question. I
no.
fully agree. I'm just wondering if you're seeing anything in between.
We found it's very hard to pick the names. Who are the winners? I think most people would say, oh, Alibaba, but Tencent has been outperforming. I don't think anyone saw Pinduoduo and their incredible growth with Temu. But even this little company, online gaming company, NetEase, NetEase has outperformed Alibaba the last 1, 3, 5 years. So we think there's a beta element, and Harry Markowitz would be proud that his efficient frontier curve works with Chinese internet stocks. So yeah, listen, we like the basket approach, partly just because we think it's really hard to pick the individual names.
No, and I'm with you. And we do tend to see some people on the that are more self-directed and more a bit on the trading side. They will try to play individual names, usually through options. It's a very different game, though. Here we're looking at getting exposure for a directional move in that whole China. In this case, it's more tech related with the K-Web. The other thing, Brendan, that I thought was really interesting, and I think this is where a lot of people are also not really getting the facts straight, is your point number 4 about calling the consumer alive and the economy improving. And I guess both of those things are probably equally confusing by a lot of people. One thing that really caught my attention is the chart that you put up, and it's on the screen here for those people that can see it, basically showing the savings versus the consumer expectations. Does that play to some extent into the bullish thesis? Because I'm not actually, it's actually a question for you. I don't know if you know this. What percentage of Chinese nationals actually own any equities at all? Is it low-ish like in the US, or I would imagine so?
It's very low. And that's that, we say the Chinese are communists, but they're not socialists. Here in the US, you have a social safety net that simply does not exist in China.
Yep.
Their social security is very limited. Their health care is very limited. And that explains why they save so much. And the vast majority of that money has gone into very safe investments like bank deposits, the bond market. Historically, real estate has been a one-way winning trade. And so real estate was where a lot of money went. Estimates are between 50 and 2/3 of urban household wealth is invested in real estate. So equities and mutual funds, ETFs, it's very low single digit. And that is changing. It is institutionalizing. But most of the money went into housing because as Chinese cities grew in size, it made real estate investing a one-way trade. If you've invested in real estate in Florida over the last 20 years, it's been impossible to lose money. But that's like China over the last 30, 40 years. And the last 3 years, real estate prices have fallen. And that's leading to the consumer being a little bit more conservative, and why you see so much policy support going to stabilizing real estate prices, because it's having a knock-on effect on domestic consumption. But it's also affecting China's economy, that the lack of new property sales means less construction workers, less electricians, plumbers are working. It means less new apartment sales mean less new home furnishings. So real estate is an issue in China. No one believes it'll create their Lehman moment in China, but it's weighed on the real economy and it's weighed on domestic consumption, which is why you're seeing a lot of policy support. Their economy, they really hurt their economy. We call it zero COVID. In China, they called it lives first. But you shut your economy down, it hurts the economy, and it's coming back. It's just coming back slowly.
So there's no, or much less of a social safety net in China versus the US, or certainly Europe or parts of Europe. Yet, of course, they're doing all these stimulative effects, from buying stocks to all those kind of things that are ultimately there to help. What about the economy itself? So we touch on the real estate part, right? Because I think this is ultimately where people's analysis is based on. Oh, the Chinese economy is a tinderbox and so forth. Yeah. And I'm plenty aware of some of the analysis that goes into that from a macro perspective. Where do you come down on that right now? Because at the end of the day, you do need some economic tailwinds to be supporting the thesis here for a K-Web ETF or some of the other ones.
Yeah, and certainly the K-Web it's like a growth factor. Unlike other China ETFs, there's no financials, no energy, no materials, no state-owned enterprise. And so those companies are geared to the domestic consumption economy. And why we're more constructive is China's economy is improving, that their Q1 GDP was 5.2%. Not one of the 21 economists who put in an estimate thought it would be that high. Industrial production, similarly, just beat expectations, was much better than anticipated. Exports continue to do well, and that's a good sign for the global economy because that means the global economy is healthy. So their economy is doing well, and they've not done the free checks in the mail, the modern monetary theorists, because they'd say it's a cycle. And the economy is just on an uptake. And we saw that in the Q4 earnings and more recently in the Q1 earnings. Virtually almost every company in the portfolio actually beat analysts' expectations. Not all of them, but the majority did. And it just shows the skepticism and around what's happening there, that things are improving. Gosh, the US GDP just grew barely over 1%. China did 5 times that. And the headlines are China's about to do a Thelma and Louise, but everything here is great. Things over there are doing better than you'd think. And having been there, I was last there back in December. I'm actually going back very soon. Life seemed very normal. It was not burning buildings or anything. Life seemed, streets were crowded, restaurants were crowded, malls were crowded. It's not that there's not problems, but it's not nearly as pessimistic as Western media would paint, which is why we say focus on the data. The data will tell you. Just take China off the name, and you probably would be a buyer.
Yeah, no, I couldn't agree more with you. For pretty much all of my entire life, I've been living back and forth between the U.S. and Europe, and when you go back and forth that much, and you listen to, let's say, European media about the U.S., you would think it's a bunch of gunslinging, French fry eating weirdos. When it's chaos, it's not really day to day, like on the average, and vice versa. If you read U.S. media about Europe, you think it's a bunch of people taking naps all day and drinking espresso. Also not really the case. So I think there's some of that here as well. But there's a really interesting chart that I'm flashing on the screen, and we can touch on this. This is, we talked about it before, but I want to quickly bring it up before we forget. The KWEB ETF that you guys managed, the top 10 holdings by a share buyback yield. As you mentioned, Alibaba is leading that pack. Baidu is in there. These guys are buying back like north of 10% of their float. That's ridiculous.
Yeah, it's a very interesting. Now, part of that is if you think about these companies, the founders are the CEOs, are the senior managers. And so they have a strong incentive because they have their net worth in the stock. And so that's part of the incentive. And I think you've got like an Alibaba has said they've already spent 12.5 billion. They did 2.5 billion. They bought 5% of their shares. But we could do this almost with any of our names where you've got a founder or senior management staff, and you have these very high dividend or buyback yields that really aren't getting a lot of attention. Just everyone it's just AI and semis and US stocks. And there's some of this in people's defense. China's been out of sight, out of mind. And do people know that in Q1 alone of this year, JD bought $700 million worth of stock? I don't think anyone knows that.
For what time period is this? Let's say for BABA, this nearly 14% share buyback.
So in the case of Alibaba, they're one of the most aggressive in terms of buyback. So they've said that what the buyback yield is doing is saying based on the amount of the board approved repurchase plan, what amount of shares outstanding does that equal? So in the case of Alibaba today, it's 11% of shares outstanding would be bought back. Now, they don't buy that all back in a day. They obviously spread it out over the course of the year. So in the case of Alibaba, it's 11%. In the case of JD, it's up to over 5%. In the case of Tencent, we're up to almost 10%. In the case of Baidu, it's almost 12% now.
Yep.
So this chart's as of, we just did 331, and I'm just running these analytics as I go along. But so these are real numbers. And if you think about the 4 examples I gave, who runs those companies? It's Robin Lee. The founder of Baidu is the chairman. Who runs JD? It's Richard Liu, the founder. Who's running Alibaba these days? Yeah, Jack Ma's retired, but Joe Tsai is running the show. It's an element of why these companies want. It's in their own incentive, and we own the same stock that they do.
Yeah. I think, and that's a fascinating point. I hope this is helpful for everyone to understand, again, this sort of bullish China thesis, at least according to this analysis. I should also say none of this here is meant to be of any recommendation of any sort. It's just purely for educational purposes. Listen, Brendan, this has been very informative. Again, I'm honored to have you here. Any last parting thoughts as it relates to the China story and K-Web or anything else for that matter?
No, so we're very appreciative of the opportunity, and hopefully we've given a different, data-driven perspective on what's happening there. And certainly, we recommend investors do your own research. Don't read the Western media. Go and pull the 10Ks, or on craneshares.com, we have a wealth of resources to help you make an investment decision. Now, this is volatile. I say, you're talking about the K-Web's volatility is 3 times higher from the S&P 500. So you got to curb your enthusiasm just because you got to volatility adjust your positioning, because it is really volatile. And while we're positive, I can't predict the future. That's why it's a small piece of hopefully a well-diversified portfolio.
Absolutely. And while you were just giving us that great summary, I just put up a quick chart of K-Web here. And for those people that like to look at charts, you can see that there may be an attempt to do some sort of a breakout at some point here. But
and I think this little pullback you're showing, Serge, is if you do it with the RSI, the rally we had since the end of January, we got up into that above a 70 RSI, kind of an overbought. So it's natural that we get this kind of pullback consolidation. That's healthy for a rally.
Definitely.
And that's where we think we are constructive. We're highly biased, but at the same time, we do think there's a real opportunity.
Yeah, no, I think this is great. And again, the whole point was to give people a bit more perspective as to the kind of data that might be worth looking at for something like this, the China story or other stuff out there as well. Brendan, thank you so much, man. Much appreciated. And I look forward to speaking to you again real soon.
Yeah, likewise. Thanks again, Serge.